Like I said, thank you all for joining us today. Rhonda and I wanted to share with our realtor partners how to help your clients get credit ready. So a lot of what we're going to talk about today is why it's important and how we can help customers get ready. Um, let's go on to introduction. So I'm Nikki Hubbard, and you folks know me. I love to share. So I think that knowledge is power and we should learn something new every day. So I do hope that you guys are able to get some, new tidbits out of our presentation today. Um, we're going to go over, like I said, why and then how. Rhonda is a partner that I met through BNI and Business Networking International. We are in different chapters, but we have a mutual friend from Hilo. And so I met her and talked story with her. I started having a couple of my clients use her services and realized it's great to have a local partner who cares about helping people improve their credit and then their whole financial well-being. So I'm really gonna just turn it over to her after this. Rhonda, are we okay with advancing the slides or is it not cooperating for you?
No, no, we can. I wasn't sure. I can't remember what you said about the disclaimer. Did you need to read the whole thing
Oh,
or
yes.
no, you
Okay.
just have it up there?
We are not going to read this whole disclaimer, but in summary, basically anything that we say is, or quote as far as rates go, is not set in stone, and so don't hold me to it. But we're really not going to talk specifically about rates today. So, um, yeah, we can move on. I'm not going to read that disclaimer. All right. So, I did my introduction and introduced Rhonda a little. Like I said, this is what we're going to discuss, um, why it's important and how to do it. And then let's let Rhonda introduce herself next.
Yes, thank you, Nikki. Hi, everyone. So nice to meet all of you here. And happy to share the information that I have and whatever you learned online. If you have any further questions, just jump in today and ask those questions so you can get some clarity. So I'm a HUD housing counselor. I worked for a nonprofit helping people to get financially strong. And part of that included credit. And when I was helping a lot of my clients with the credit piece, I just noticed that through the education that they received, they struggled with taking the steps, right? The steps that were required for them to improve their credit, to make it better. And essentially, it was to get credit ready to buy a home. And so I looked at those struggles and I was like, gosh, there's got to be a better way. How do I do a deeper dive into learning more about credit and how do I help our community and our people? So I met a credit repair person that was based on Maui. I'm based on Maui and I serve Hawaii residents statewide. So currently I have clients in Hilo, Oahu, and on Maui. I met someone and he provided me with a little direction and some of the tools that could be used. And then I immersed myself into studying some of the consumer laws to benefit people. Once I started getting some of the results, I got all excited. I was like, oh my gosh, I think this is it. I think this is the solution, to help our community members to kind of get over some of those credit hurdles that they had been experiencing. So sometimes people ask, why are you called Kupa'a? And Kupa'a Consulting Services. And it's because I think it's reflective of who I am. And it's also reflective of the credit journey. Ho'okupa'a means to persist. And that is what you need when you're trying to improve your credit. You need to be patient, you need to be able to persist, you need to be able to take action. And these are all things I'm sure that each of you tell your clients when they're working with you. So the main thing I share with people is, start now. And I see it all over, the internet and with other lender partners and realtor partners that I have. Everyone is stating the same calling order to people is start now, start now, start early, because you never know when the right house in the right neighborhood for the right price is going to come up, and you want to be ready. So credit helps not just with, options that you have for buying a home, but it also saves money on insurance, which a lot of my clients didn't know. So home insurance, car insurance, life insurance. It also, helps with interest rates for car loans, um, personal loans, HELOCs, all of these different reasons. So what does the low credit score actually cost you? So if you have someone with a 599 score versus someone with a 730 score, here are two examples. So one is for a car loan. You get a car loan for $23,000 with a 599 score, you're going to pay close to $10,000 more in interest. With a home loan, you're going to pay $200,000 more in interest. So for clients, when they come into understanding what Kupa'a offers and the services, on the far right, we have a breakdown of the costs. So you're going to pay $75 to enroll, 1/17 a month for services, $24.95 a month for the credit monitoring subscription. So all in, it's about $150 you need to budget per month. So for 6 months of service, you're going to pay close to $1,000 to save $10,000 to $200,000. So this is the way I position it with my partners, such as you, as well as with the clients who are coming in. And Niki, I think this is your part.
Yep.
To share a little bit more on credit scores in relation to the loan programs.
Right. So we just saw a pretty clear example of how the lower credit score customer is going to pay more in interest over the loan. I'm sure you're wondering, well, what are the minimum credit scores that customers need, and what does that look like? So there's, just in general, the credit score range that people can have, provided they don't have no score, is like around 450 to 850. So if you have a customer telling you they have 1,000 credit score, I don't know what they're talking about. And I have had people tell me that. They're very proud of this 1,000 credit score. But also sometimes they'll be very, very happy that they have a 550 credit score, maybe because it had recently improved from something lower than that, but that's not necessarily good. So for our loan programs, the lowest credit score that these programs will allow is listed here on the screen. So for a conventional loan, which is sent to either Fannie Mae or Freddie Mac, the government sponsors entities that most loans are sold to, you can have as low as a 620 score, USDA 620, FHA 580. And VA does not actually have a minimum required credit score. Now, they have these minimums, but then investors and companies like VIP Mortgage and the investors that we sell our loans to have the choice of whether they want to underwrite those loans and pool those loans in and sell them onto the market. So the lower credit scores, the less investors that are willing to do those loans. And so then you're not able to shop as much between investors. So for example, if I have a customer with a 620 score, instead of maybe having pricing from 13 different investors, I only have 2 that will do it. So it really doesn't give them as much purchase power as someone with a higher credit score. So at least we got to get them here. And if we can get them here, can we get them any better? Because then it will give them more opportunity. Another thing that's been, we can go to the next slide. And another thing that has been big in the news, and maybe some of you have heard about it, was the new loan level price adjustments. And it was really framed like a terrible thing in the news that the government was doing to people with good credit. And yeah, the numbers change, but let me explain what this is. Okay, so loan level price adjustments, LLPAs, there are, this is an adjustment to the rate that's offered to the customer based on their credit score and loan to value. And this grid has been in existence. This is for conventional loans. there's a different grid for USDA, FHA, VA. So what changed in the news recently was the adjustments in this grid. They increased in some areas for the, unfortunately, people with better credit. There were some increases, and then it decreased in some areas, mostly in the first-time home buyer lower down category. So if you look at this grid, a person with excellent credit, like right here, if they put 780 down and they put 25% down, they're going to have no adjustment to the base rate that's offered. And then if they put less down, you know, like only 5%, they're going to have a quarter, an eighth adjustment to the rate. But conversely, if someone comes in, wants to do a conventional loan, they have, you know, 625, they just barely made it to the minimum, and they're going to, you know, put, maybe they have 15% down. They're going to pay 2.875% more in fees for that same rate than someone with a good credit. So there's another just clear example of places where weaker credit costs the borrowers more money. So the better credit we can get them, the better off they're going to be. Now it's not as big an adjustment if they're going to put lower down. Here you can see this 95% column. The adjustments are not as big, but still, the lower credit score adjustments are way more than the higher credit score adjustments. And so that's what I want to talk about on the loan level price adjustments. I don't have an opinion whether it was bad or good or whatever the government's doing to us. This is the way it has been. It has been adjusted recently. It is always better to have better credit because it will cost you less to get a rate for your loan. And so now we're going to move into what can we do about it if we, you know, how can we help our customers? I'm going to turn it back over to Rhonda to talk about that.
All right. So to increase your mortgage approval rates, your client has choices, you know, so the first choice is over on the far right where they can go with credit counseling. So there's credit counselors that are located statewide. They're mainly the nonprofit agencies. They can also tap into ones that are located on the continent. And essentially what you're going to get from that type of service is you're going to get education. You're going to get a great cheerleader that's going to assist you and help you along the way. But essentially, if you need to dispute anything that's on your credit report, you got to do it yourself. So it's kind of like a DIY program. They do also have access to some resources within the community that might help that person. So some of the resources might be a debt consolidation loan, like CNHA has a debt consolidation loan, Hawaiian Community Assets has a debt consolidation loan, and they're usually sometimes a little more willing to give people approval rates versus going into a credit union or a bank based upon their score. The second option, the middle column, is DIY. You know, so you have someone who Googles it, they look at YouTube videos, they try to learn, they try to figure it out, and they want to try and save money on the fees, you know, to manage their monthly budget. So they give it a go themselves. And so they can do that. So they can dispute online or they can dispute by writing letters based upon what they've learned on their own. And then on the far left is the Kupa'a program. So this is a done for you program. The services that you're paying for is you're paying for someone who has knowledge of consumer law. And we use that consumer law to be able to remove late payments, collections, update late payments to positive, bankruptcies, foreclosures, these types of things. Everything that's on your credit report stays on anywhere from 7 to 10 years. So if you have the opportunity to be able to get some of those items off of your credit report using consumer law, then you can boost your score. The other thing we do is offer credit education. Oftentimes I find that people, you know, have high credit utilization, and that's an easy fix for them to be able to boost their score there. So it's through that education that they never known, you know, about credit utilization, how to use that, how to play the credit game. So those are the other things. Because of my HUD housing counselor background, for those who come into the program and their goal is to buy a home, then I'll go over a home buyer readiness assessment with them, talk to them about down payment savings, down payment programs that I'm aware of. Like here on Maui, we have workforce housing, and there's developments that are coming up that certain AMI qualifies them for the workforce housing. So we'll review that so that they understand what it is and whether they should pay attention to that or they don't qualify for it at all. Then we also do negotiate pay for delete. So pay for delete is when you have a collection and you negotiate either to pay it in full or you pay less than what's owed in agreement with the creditor or the debt collector to delete it from the credit report. So we've had clients who've come in and they paid 50% of what they owe, and then it's come off the credit report. And then we have our referral network. So for some of our clients who came in, we refer them out to refinance their car, get lower payments because their credit score boosted up. So they're at that point, instead of paying 15% or having a lease because that's all they qualified for. Now they qualify for some of the better rates at 2.99, 4.29% for their monthly car payments. So the money they save with the monthly car payments can now be shifted towards down payment savings when the goal is to buy a home. We also connect them with the right insurance agents, and with the insurance agents, sometimes they learn that through bundling, they get discounts, and some of them have saved anywhere from $50 to $125 per month on their insurance program. So again, same concept, whatever they save there, they can shift it towards their down payment savings. And then we have the credit buoy. So the credit buoy would be yourself as the realtor, Niki as the lender. We work together to benefit the client. We keep each other posted on what's going on throughout the process. So who do you know? Who do you know that's come to you, that's tried to get a pre-approval letter, they were denied, and they weren't really clear as to why, and maybe what we can do is do a free credit audit. So if you go to my website, have your clients click on the get free credit audit button, that's what starts the process. The credit audit itself is pretty informative, and it allows people to be able to learn from it. So here's an example of what they would get. It's a lot of words on here, but essentially, this is a client who had the low 600 scores. I'm guessing and estimating that we can get them up to 680 or higher. The first point that we go over is collection. So this is part of the education piece where I'm sharing with them, okay, this is what a collection is. This is what you can do for delete. And this example here from the credit report is from a debt collector. The two biggest pieces that impact credit that people, clients have total control over is credit utilization and payment history. So this is 65% of the score. So here I'm highlighting for this client that, okay, your Capital One card is at 105% of the credit limit. So if you get that down to 30%, so I map out 30% is $1,590, you're gonna see your score boost. And what you want to do when you're buying a home is you want to keep it at 10% or less. So 10% or less is at 530. The other thing they need to know is that when is this reported to the credit bureaus? It's reported on the statement end date. So each of them go back, log into their account, check when their statement end date is, which is different from their due date, so that they're aware. That's when it reports, that's when my payment needs to clear. So I've had clients who've come in, who've made payments, but the payments came in after the statement end date. And so we pull credit during the credit repair process once a month, every 32 to 35 days. So the federal laws say that when we dispute something, the bureaus have 30 days to investigate and to respond. And so it's kind of critical for the client and then for us to understand that concept and to ensure that if we want to see some score increases in the next month, then they need to pay attention to those statement end dates. So someone doesn't need to enroll in credit repair to do this. This is something they can do on their own. So with each of your clients, if you notice that they have high credit utilization, this is what they would need to do, is to adjust these credit behaviors and to pay all of these down to 30%, then eventually to 10. Next is late payments. So if there's someone that has a bunch of late payments, check and see, have they improved over time? Are they better now? If they get a new late payment, it'll drop the score anywhere from 50 to 100 points with a new late payment. So it's pretty significant for them to make sure that they're able to pay everything on time.
And just for late payments on certain programs, they're only allowed, like in government loans, one late in the last 12 months for FHA and USDA. So lates need to be cleaned up.
Yeah, and then next would be increase. Increase are 10% of the score, so it's a little less, and it's not an area we totally focus on. But when we have clients that come in with 50 plus inquiries, we do have a conversation around that. You know, okay, what was your intentions with getting all these inquiries? You know, let's scale it back. Let's not apply for new credit. So increase count in the algorithm for the score for 1 year from the date of the inquiry. It stays on the report for 2 years. Then the last piece is giving tips on credit mix and credit building. And I'm going to give you a screen that you can take a picture of with those tips as well. So again, sharing with the client, these are things that they can do on their own. They don't need to enroll in credit repair to be able to do this, but providing them with an avenue for them to improve their credit mix on their profile overall. So you want to have 2 to 3 credit cards and 2 installment loans on your credit report. So if you have clients who've paid cash, who have credit cards, but they don't use it, they need to use it. It needs to be active. They need to put like one thing on there. So for credit cards, oftentimes what I tell people is, do you have any subscriptions? Do you have Netflix, Hulu, Apple, anything? Okay, on credit card 1, put Netflix and set it up on automatic payment. That's $20 a month. Credit card 2, set up Hulu, put it on automatic payment, set it up. By showing that you're an active user of the credit card, just for those simple things, it doesn't matter whether you max it out or not, that's going to help to boost your score overall. And then for installment loans, we have savings account programs where you put money, like $25 a month into a savings account, but it reports to all 3 bureaus as if it's an installment loan. And then at the end of the term, you get all the money back that you saved, and you can put that towards your down payment savings. Okay, so here's the screen that this is what you could share with your clients. The self credit builder is the one that I always recommend. So it's $25 a month for a period of 2 years, no hard credit pull. You save $600 over the 2-year period, and then you get the money back, less a little bit of an administrative fee. The 2 credit cards that I always recommend people enroll in is Capital One. There's no hard credit pull with this one either. And if you look at this far right picture here, I always go over and tell people, check on the boxes to build credit and no annual fee. Then with Discover, there's a cashback reward card. This is one of the highest ones that gives about 5% cash back. So if someone needs 2 credit cards, then these would be the 2 that I would recommend. Now you can add up to 20 people onto your credit card as an authorized user. I don't know if anybody knows that. I didn't know that, that you could add up to 20 people. So I tested this with my 19-year-old son. When he turned 18, him and his cousin, they were both 18. I said, okay, I'm going to test this on you guys. Let's see how you do in 6 months. So we enrolled them in self. They had to do it themselves, and they were both working. They had to put a down payment on a Capital One secured card. So they put $200 down each. They did not enroll in Discover. I added them on to 2 of my cards as an authorized user. I did not give them the card. I told them that I'm simply adding you on so you can get my credit history and you can get my payment history as well. Then 6 months later, guinea pig number 1, my son, his credit score was at 800. And he was able to then go and get a car loan. That was his motivation, was he needed to get a car loan. Guinea pig number 2 didn't quite get there to 800 because was spend, and didn't keep the credit utilization down. So everyone's different, but you provide them with the knowledge, you provide them with the tools, you continue to reinforce the concepts and the behaviors that are required, and they can do it, overall. And then every 12 months, always ask for a credit limit increase. So I tell people their credit limits are at 300, 1,000, or 2,500. I tell them, get it up to 5,000, get it up to 10,000, get it up to 15,000. It doesn't mean that you go out and you spend and don't live within your means. What it does is it shows lenders that you're responsible and that they can take the risk with you and they're going to give you the loan. So you want to be able to build your credit and build your limits up to reflect that. That's what you're doing. So let's look at some of our client results. So this is a client who within 60 days, 14 of 30 negative items were deleted. They understood that for all their collection accounts, it was money that they owed. You know, they recognized it. We did a debt validation letter. It all came back with the validations showing, and they waited for their tax return to come in and committed that they would then like to do the pay for delete process. So I hopped on a three-way call with them to help guide them through the process and empowered them to be able to have those conversations with the different creditors. We were able to negotiate for that client to pay $7,200 of the $12,000 that was owed. So that's 60% pay for delete. So, you know, that's a little credit win for them. In this particular credit pool in March, 9 items were deleted. And so their score jumped up 44 points, 11 to 50 points overall. So every month is different. And then here's examples of collections. So the main debt collectors are Midland and Portfolio. So this one is using the dispute reason, and you can see some of the consumer law references that we have there. So for Midland Credit, we got it deleted. Portfolio, we got it deleted. IQ Data International, this one was also deleted. So it doesn't happen in month 1. It doesn't always happen in month 2. Someone should always think of being in service for a minimum of 6 months. With this client has quite a bit of negative accounts. So this client, I would say, would be someone that could be in service for up to 12 months because it's taking them years to get to this point. And we do our best disputing everything on a monthly basis to try and get things off. And in this case, you know, we got these 3 accounts taken off in the same month. So this is another example of a new homeowner that's on the Big Island. So this person on the left, with the 14 items that were deleted, they came in with a 500, a low 500 score. They had a lot of collections that they were just ignoring. They weren't originally going to be on the loan. Their boyfriend was going to be on the loan, and then ended up that the boyfriend's child support payments made him ineligible for qualifying for the loan. So they needed her income in order to qualify for the loan. So she came to me in a panic because they had already put in an offer and they were trying to close the loan. And so within a 2.5-month window, we were able to pay off the collections, get most of the negative items deleted, and then we're still working on a few other items that are coming in. But it got them to where they needed to be. They got approved for the loan, they closed, and they moved into their new home. On the right, this is someone who is a business owner on Maui, had excellent credit prior to COVID. During COVID, went into forbearance with a couple of accounts, was able to clean it up, but the original lender would not adjust their file to reflect that they had caught up. So they called them, they went into the bank to talk to them. They tried multiple avenues and pathways to be able to correct it themselves. Then they came to me and they said, okay, we're not getting anywhere. We got this one account. Is there anything you can do for us? And we were able to get it updated to positive after 90 days. And then they were able to qualify for their HELOC at that point. So this is our first bankruptcy accounts that we got deleted. So on the left with TransUnion, the bankruptcy was deleted. For TransUnion, we're still working on Equifax and Experian. And then there's also about 12 to 14 secondary bureaus. So LexisNexis is one of those secondary bureaus. And what they do is they collect data, and that's their business. And then they sell the data to the bureaus and to banks and to lenders, you know, about people, and they're the holders of some of the negative information. So when we're disputing not just with the bureaus, but we're also going to some of these secondary bureaus, whatever's going to work to help benefit the client. So on the far right is the example of the bankruptcy being deleted from that secondary bureau, LexisNexis. The buy car and get a college home is for a local family whose son is in the mainland. And they had just not been paying attention to some of their due dates. And so their credit score disqualified them from qualifying for a car loan to buy their son a car loan, buy their son a car. And so they came to me. We were able to visit some of the credit utilization items that they had, which they could do on their own. We set them up with Self to start building credit for one of the profiles. And then we started to clean up some of the negative stuff that were on there. So here's 5 accounts that were updated to positive. Score went up from 29 points to 86 points on this profile in this month. On the right is divorce cleanup. So who do you know that's one of your clients that's bouncing back from a divorce? You know, it's one of the biggest struggles that people have, because when you're going through the divorce, part of the decree separates not just assets, but it separates liabilities. And if you have any joint accounts, even though person A is assigned the responsibility to take care of that car loan or that personal loan, if your name is still on it, you're still responsible for it. So if person A doesn't pay it, then your credit score is going to be impacted. And that's what I'm seeing with quite a bit of people that are coming in who are going through this period. So we kind of talk through and work through some of that responsibility, in them understanding that, okay, if you're trying to get approved for the home loan, you either got to decide to pay the car loan, even though your spouse is the one, your ex is the one that's assigned to do it, or you're not going to get approved. So you got to figure it out. But we get some of the other items deleted. And so in this case, 7 items were deleted and 3 items were updated to positive. So they're not quite where we want them to be, but we're on the way. Okay, so this is someone who had 2.5 years of late payments. So it's all of these yellow spots is 30 days late that's being reported for 2.5 years. That was inaccurate for a line of credit. And 90 days later, all the green boxes represent the success we had with getting it updated to reflect the correct payment status and payment history, and this person was able to qualify for their loan. This client came in with his wife, and he got denied for a pre-approval letter. And the reason why he was denied was that credit utilization was high. So it was 95% with the credit one bank and 114% with the second one. This client had the means, meaning they had money saved up to be able to pay off all of these debts. So they went ahead and paid these 2 off within the first few weeks. Then they had 4 collection accounts, which is the ones that you see here. And we jumped on a call, 3-way call, and we did a pay for delete for all of these. 3 of the 4 agreed to delete. Chase credit card typically never agrees to delete. They haven't done it with any of the clients that I've worked with. But the other 3 were deleted overall. So where we ended up is within 41 days. So this is an example of a client who was super on it. We were on the phone and working on it 2 times a week for 3 weeks, trying to get everything in order. They were very eager. So 41 days later, their score went up from 112 points to 176 points, with 12 items being deleted. So there's possibility it can happen. It depends upon the client, in them following some of the tips and the suggestions. And it depends on their ability to pay down collections and some of the debt that they owe. But altogether, if they're able to kind of get on that pathway, and implement some of the credit strategies, then they'll be able to get this type of success too. And my hope along the way, right, is that people gain the credit knowledge that they need to be able to maintain their credit profile after, and that they teach their kids, you know, so that we're starting to build the knowledge, build the comfort level, and start having people who are entering into adulthood with the right mindset and the right skills to be able to build credit to use to their benefit. So this couple was able to purchase land, and they're in the process of trying to figure out what it is that they want to build. So that concludes the examples that I have of my clients with Kupa'a, the successes that we've had. And you know, what you would do is you would just send them to the website, click on the free audit. If you have particular questions, you can always give me a call, or you can text me and we can hop on a call and we can kind of talk through it and figure it out. And if you want to be kept updated on what's happening, then you just let me know. And then when I send the monthly updates by email, then you can be included, you know, in that update as well. And I invite you all to follow me on Instagram or Facebook. You know, I put credit tips on there, client results. So you could maybe in seeing some of these, it might trigger something about a client that you have that you might be like, oh, okay, maybe they could benefit from this. So I welcome you to do that. And we're having one more workshop, you know, Niki and I, we're going to do one for the community. So if you have any clients right now that you think could benefit from understanding a little bit more about credit, what it is that they need to strengthen and how they can improve their profile and why they should improve it, you know, as far as saving money and interest things, you know, oftentimes people go, I got qualified for that car loan, I'm good. Well, you're qualified at 15% or 12%, you know, interest. You have an $800 car payment when you could have something that's a lot less. So that's what we're trying to inspire people to live within their means, to use credit to their benefit. And at the end of the day is to get more of our local people into homes overall. So I invite your clients, come join us.
Yeah, so leave this up for a second. Most
Okay.
of you should have gotten, hopefully you got an email for this one with the QR code. You can, you know, forward it on, scan the QR code now if you need to. We will be posting it on our Instagrams as well. But we definitely thought that after you folks hear from Rhonda and I today, that you might trigger, you know, oh, my client that I haven't talked to for a while should hear this as well. And you could refer them over to listen in later this month. So that is what we are hoping you guys can help us do. And yeah, we can definitely go to questions for the rest of our meeting. And I see some coming in the chat. All right, Gina came on a little late, so she was asking what is the cost for your services?
The cost for services is $75 to enroll, and then it's about $150 a month.
And it takes about, it can be, you know, depending on how aggressive they want to be, but 2 months to a year to take care of everything.
Yep. I had one client that had one item that it was 1 month. That was the only client I ever had that was 1 month. But everyone is at least 3 months. And usually it's going to be 6 to 12 months that it would take. So it just kind of depends on what's on their credit profile. And bankruptcies take up to 12 months.
Okay, and Kupono has his hand up.
Thank you. Yeah, very good presentation. I was noticing throughout the slides that, I mean, at least it gave the appearance that Equifax presents the lowest of the scores of the three, and it looked like Experian was on the opposite end of that, showing like a higher score. I have a couple of credit cards. They have apps. They allow you to see, you know, your FICO score. One is saying there's like a FICO 8, the other one's saying like a FICO 9. Why are some scores higher than others, and which are the ones that you got to pay attention to?
Yeah, so when you look at your credit profile, then you look at how many accounts are reporting to it. So it'll identify this account is reporting to TransUnion and Equifax, but not Experian. So that's one thing. Not all accounts report to all three bureaus. So that factors into the algorithm when calculating. Same thing for inquiries. Not all of them report to all three bureaus. And then the scores that I'm showing you are Vantage scores. So The system that I use is the Vantage scoring system. None of the credit repair companies use the FICO, but it's very close to it. So what I share with people, because FICO is what's used for mortgage, what I share with people is if you see your score go up or down, here it's going to go up or down on the FICO. And if you want to be able to monitor FICO at the same time, then I have them enroll in the My FICO, which gives all three, and it gives all the details with related to each of the accounts.
Yeah, it's a good question, Capono. The mortgage scores, when we pull our tri-merge reports, we often see if someone had been monitoring on a consumer monitoring service that it's going to be around 20 points lower. But I wouldn't, unless Rhonda says to, I wouldn't enroll in both because, like she said, one going up means the other one is probably going up. So it's very similar. It's just a different scoring model and a computer that just, takes the data and spits out a number. So we're just trying to get the number to come out higher.
Thank you for that. I had an additional question too. In the presentation, we talked about vehicle loans, home loans, credit cards. So how, if at all, do something like personal loans factor into credit score? And a follow-up question to that is it better to leave a personal loan open on auto payments until it's paid off, or is it better to pay that off in full if you can?
So I would say anytime you have a loan, it's better to leave it on there unless the mortgage lender says your DTI is too high and you have to pay something off, So the reason why leave it on there and keep paying is because you want to show that you have 1 to 2 installment loans and then 1 to 2 credit cards. So whenever it comes to paying something off, always pay off the credit cards first because the interest is so high. It doesn't make sense with regards to that. Does that help? Hold on.
Yes, it does. And regarding to one of the biggest things I learned recently, but you touched upon earlier, was a credit utilization. And I didn't realize, like I charge everything for my business on the card. I'm getting Hawaiian miles for it, and I have the ability to pay it off when I get the statement. But I didn't realize, you having $5,000 worth of charges in a month that you can pay off, and I usually pay it off within 1 or 2 days of the statement coming out. I didn't realize that was negatively impacting my credit score based on the utilization. So I guess the goal then is before your statement is printed or closed, make payments to pay that down to anywhere between, I guess, 10 to 20% of the entire utilization or limit for that card.
Yep. The key is the statement end date. If you're someone that uses it, like you said, for a business, you can max it out. That's fine. But by the statement end date, just make sure that what's reporting is less. So that 30%, once you go over 30%, your score will drop. So you'll see for that month, you can kind of play around with it. So you can kind of see your score fluctuate. So 1 month you can, maybe pay it down to 40%, see what happens. The next month, pay it down to 20%. So you'll see that your score will go up and down between 25 to 75 points.
Okay. And I'm going to lower my hand. That's all the questions I had. Thank you.
Thanks,
Right.
Bono.
We have some more from Gina in the chat. So she wants to know if we can clean up credit for a veteran who had late payments, if it take how long that would take. The client sold their home but was unable to repurchase right away due to recent lates. It was related to the son making a mistake for their parents and paid late on their old loan. The loan is now paid off and they want to purchase. So any idea how long that could take to clean up?
So that's a closed account with late payments, right, Gina? Yeah. So closed account with late payments, we'd go to, depending upon the credit profile, but anything that's closed, we'd go to delete the account altogether. Unless they really need the credit history. So it might be, we need to evaluate and discuss that. But late payments can take anywhere from 3 to 8 months to get off.
Okay, that's what they were told to. Thank you so much.
You're welcome, Gina.
So I had a question. You mentioned the self signing up for the self credit. It's $25 a month. Is that that also has a self credit card? Self Inc. Is that the one?
Yeah, they have a credit card too. So I see some people sign up for the credit card because once you log in, then they try and, get you to do other things. So with credit cards, the conversation I have with people is, okay, what is your family priorities? Like, are you someone that travels, so you want miles? So like Pono mentioned the Hawaii miles. I have Hawaii miles too, because that's what we do is we collect miles for Hawaii, for our family. But then for others, they want to use United, like I've run across, because that's the carrier that they use. For another one, they want to collect hotel stays and hotel miles, right? And so it just depends on each family and what their goals are. We talk about getting the right credit card mix for them. So start off with something like Capital One, which is um, no annual fee. Always look for something with no annual fee. No annual fee, increase your credit limit, over time, and then add on the rewards card after, so that would be cashback. So I have a cashback and I have Hawaiian Miles card. So the self one, I'm not sure, like, how would that fit? How would that fit into the family goals? So that's why I'm bringing it up, is they always need to evaluate, does this fit and does this help my family in any way?
It is so case by case too. A lot of this, we know we're seeing lots of generalizations and examples, and some things are really common, but a lot of it is so individual. And I think a lot of people are, they just need that extra encouragement to go and get that extra help. Like,
Yeah.
and I love to offer the help from someone local and not just send them off to some corporation in the mainland with a phone, like a phone bank or call center, and then it's just frustrating. I mean, if you can do it yourself and go ahead and try sit on Experian, TransUnion, and Equifax customer service line and probably go insane, or you can have someone help, right? So I think just encouraging anyone who is, thinks their credit is not great or needs help, to take advantage of the help we have here locally. So it's really glad that Rhonda has brought this service to the community. I wanted to mention two things related to loans. I don't know if you guys know this, but so the screen where she had listed all the inquiries, someone had like 11 inquiries. If a customer is like paperwork adverse, which most customers are, um, we're going to need an explanation letter for every single one of those inquiries in the file. And we're going to need to know whether new credit was obtained or not. And if it was a new inquiry and they did get a new account and they don't have a statement yet, it is kind of a fiasco and kind of stops us from being able to proceed on the loan until we have that new statement with that new accounts terms. So inquiries is you avoid allowing people to have inquiries during their loan process, but even before, it's just a bad habit. And then as far as authorized users go, it is amazing trick. It did the same thing Rhonda did with her son to my husband, and he now somehow has better credit than me, which is a common competition between couples. The women mostly win though. Anyways, authorized user accounts in some loan programs, they will review the credit very closely. And if the customer really only has credit based on an authorized user account, they won't really accept it. So they may require that they get additional trade lines. And that just means more paperwork if we have to do non-traditional trade line documentation. So definitely what Rhonda said about the credit mix of having a couple of installment accounts and a couple of credit cards, and not only authorized user credit cards, but also some they are personally responsible for. So I just wanted to share that about authorized users. It's a great idea, but it can't be the only way that they obtain credit. And anybody else have other questions?
I do have a question regarding the authorized user discussion you were just having. It might have been answered earlier, but if somebody authorizes you to be a user on that credit account and the authorizer ends up defaulting, missing payment, stuff like that, does that become a reflection of the authorized user?
You get
Yes.
both their good and bad history. So definitely do not go on to don't become an authorized user on someone with bad credit, and make sure if you are on there it's good, because you'll inherit it both ways.
Yeah, so Pono, you can call to, someone who has that, they can call as long as they know who the original credit card holder is. That's the information they would need when they want to call on their own. So I have two cases. So I have a current client who's a general contractor who's on as an authorized user for an account that's negative. He doesn't remember who it is. He thinks it was a client from many, many years ago. And so when he called, because he didn't remember who the original credit person is, they wouldn't let him remove himself from it. So we're gonna write a letter to get it removed that way. So that's one thing. I think that's very unusual, that you're on as an authorized user, but you're not sure who you're with. And then there is someone else who's, either on because they're with their parents or auntie, uncle, or someone else. And if they call and they say, I'm an authorized user, I want to get myself removed, this is who the original account holder is, then you should be able to, with a phone call, get yourself removed.
That's good to know. That was going to be my next question.
Yeah, and then about how long after you're removed will that history go off of your credit? It take like a month to cycle on off.
Yeah, so when you look at the credit report, there's a date, there's a line that says date reported.
Mm-hmm.
So the date reported is usually for the same as the statement end date for credit cards, or the date that that particular account is going to be reported. So as long as you remove yourself and it processes through before the date reported date, then it should be reflected in the next month.
Great. Awesome. Okay, last call for questions. We're just getting close to 11, and we were going to be on here for an hour. So any more?
I have one more, but can't really put it in a credit perspective. But we're mainly realtors here on the call. We're 1099 workers versus W-2 workers. Is there any kind of difference in the process for getting a home loan? And maybe if there's a credit difference, I'm doubting that there is, but what are the main differences, I suppose, in applying for a home loan, 1099 versus W-2?
Yeah, so credit wise, I don't believe there's any difference. But as far as income qualification goes, it's very different. So W-2 is usually an average of your last 2 years' earnings or your current wage if it's a salary or hourly. For self-employed, it's a 2-year average of your net income on your Schedule C, and if you have anything depreciated, we can add that back in. So quite different. Not your gross income, it's your net income.
Thank you.
Well, we appreciate you joining us. Thank you so much. I will try to share the recording, and you guys hopefully grabbed Rhonda's info. And if you don't have it, I'll send an email out afterwards. But have a great rest of your day. Thank you guys for joining us.
Thank you.
Hey, everyone, nice to meet you. Thanks, Nikki.